to come. But of course, for now, everybody is a little bit upbeat because of this European IMF. So what is going to happen? I'm going to divide my conclusion in two things, in two sections. The first is like what is going to happen in the short term, and what is going to happen to a longer term. So short-term outlook, I think that two of the things that people are talking about, especially in Asia, are basically not going to happen. One is countries that will actually default in Europe. And the reason that why countries are not going to default is not that the situation, the public finance situation is better than what we think or what is expected, quite the contrary, but because it would be a huge cost for the community as a whole. And then and then you will see some kind of I mean, everybody get together and try to help, because otherwise it's going to affect their economy significantly. So huge cost for defaulting country, huge cost for non-defaulting country. For defaulting country, take the case of Spain, Greece, and Portugal, which are running a trade deficit. So if you have a country that is running a trade deficit that eventually defaults, then the whole adjustment, since it cannot be financed, it cannot look for financing in the market after the default, it has to adjust its international position, and so you will have to have an adjustment in trade balance. So it will be particularly painful for these countries. Not only they will not be able to find financing, but also they will have to rebalance their external position through trade, exclusively through trade, which will mean that the recession that is following the default is going to be even worse. And for non-defaulting countries and for non-defaulting economic agents, the situation is even clearer, that they cannot allow Spain or other countries, Greece, to default. Look at the structure of the holding of Greek debt. 45% of Greek debt is held by banks. So basically, if you want to recreate a situation in which banks stop lending to each other, such as the one that followed Lehman breakup in September 2008, then you basically you actually let a European country default, such as Greece, with 45% of debt that is held by banks, and with banks stopping lending to each other, and the replica of this liquidity crisis you had in 2008, 2009. So it will be a huge cost for both defaulting and non-defaulting countries. The other thing is the breakup of the euro. Also another thing that, in my opinion, is not going to happen. Of course, South countries, as in countries that are running public finances difficulties, have no intention at all of being outside of the euro. The only advantage they would have is that they can devalue their currency. But basically, this will come with a series of huge setbacks on interest rates, and probably the interest rate cost will outweigh the exchange rate benefit, and you will have a situation in which those countries are not able anymore to finance themselves unless they pay 19, 20, 25% on 2 or 5 or 10 years. So it's going to, for those countries, is completely out of the question that they leave the euro, and Greek politicians were quite clear on that. We're never going to leave the euro, otherwise we will be dead. And for North countries also, a lot of people say, okay, the Germany should leave all these Mediterranean countries that are only spending the savings of German people. Look how beneficial was the membership to the European Monetary Union to German. Here you have unit labor cost, and Germany is in red. I don't know why I choose red, but anyway, Germany is in red, and you see the huge increase in competitiveness of German exporters due to the fact that they had a single currency with the other countries, and all this. So it's mostly 50% of relative increase in competitiveness. And the day there is the German mark again of some other Teutonic currency, you will have probably overnight a wiping out of 15 years of sacrifices by German labor force, who has experienced a significant cut in their ability to spend and purchasing power due to the fact that unit labor costs were kept very, very low by corporates. So basically, overnight, you will have a wiping out of this huge competitiveness gain, and this, of course, is not acceptable on an economic basis for Germany. So what is the problem? And we go to the long term here to finish, to end this brief talk on the euro. This is the problem. So the problem is fiscal consolidation, and I think that this is the critical issue. The speed at which fiscal consolidation is going to happen. Fiscal consolidation as in reduction of public deficit and eventually public debt through either increasing taxation or a decrease in public spending. So these are the promises that were made by countries at the European Commission, before the European Commission, and you see that most of the country would be below 3% according to them by 2012 and 2013. But this entails, if you take data from 2010, significant cuts in deficit that are probably kind of utopia if you take some, especially if you take some countries. So what is going to happen? Let me try to explain why I think that this is really the root of the transformation of a crisis from financial contagion to macroeconomic contagion in 2011 and 2012. So why are we going to see extremely low, extremely weak economic growth in Europe? This is a normal business cycle, and you see the trend in green, and you see the shorter-term fluctuation of a business cycle in blue. And this is today, I mean, what is happening today. So basically, you still have those fluctuations, and then you have this big crisis on the blue line that brings down the trend. So here you have a situation in which it's not a normal cycle, but the last recession has provoked a permanent step down of the potential growth, of the trend growth. So we are starting again to increase with the green line on the right side, but from a lower level. And for some years we have to recoup all those losses that are permanently that is the permanent loss in the economy. You see it. So why I'm saying? Oh, let's see this first. This is, you see it basically the same graph, but with real data and with our forecast. You see here U.S. and Germany, and you see very clearly this. Just it just is going one step down the trend growth, which is extremely impressive, and the situation. And here you see that the trend growth approximately gets back to the same slope, so the same potential growth. But look at what happened in Spain and Greece. Sorry, according to our forecast, here you not only have this step down, but you also have a situation in which the trend growth, so the steepness of this increase in GDP is permanently affected. So why we think that this is going on? Why we think there has been a permanent loss in GDP? Look at the two main, two of the largest motors of the economies years back, which is the construction, as I said, and bank credit. You see bank credit, the situation with the huge deleveraging that is still going on and is still going to go on for 2 or 3 years, or even more in some countries. And look at building permits. Look at Spain. Spain was at some point was building more than 1 million residential unit per year, and obviously they kind of destroyed their territories, especially in some beautiful regions in the south, and they have basically built for the next few years. So this is not coming back. This is permanent loss in activity. So it's not that with the economic cycle going up, we will have these jobs back. And what Bill was saying for the U.S., that the unemployment rate is going to stay high for some time. I think one of the reasons is also that also in the U.S. you have some jobs that are not coming back, that are permanently destroyed, and this is even truer in Europe. And then there is a deceleration, the data that you saw also yesterday in Chinese FDI, a continuous deceleration in, acceleration in delocalization